Deciphering the Treasury's $731 billion cash reserve. The United States government's Treasury Department has accumulated a substantial amount of cash, currently totaling $730 billion, in an account known as the Treasury General Account. This raises questions about the purpose of this massive stockpile of cash and how it impacts the economy. To understand the significance of this account, we need to delve into the financial crisis of 2008 and subsequent changes in monetary policy. The shift from regular bank accounts. Prior to the 2008 financial crisis, the U.S. government stored its cash in regular bank accounts, similar to individuals. When the government received money from taxes or borrowed funds, it would be deposited into these accounts. Conversely, when the government spent money, it would be debited from these accounts and transferred to the recipients. Debt monetization and the creation of the Treasury General Account. During the financial crisis, the Federal Reserve implemented a practice called debt monetization, also known as quantitative easing, QE. This involved the central bank printing money and lending it to the central government. The Federal Reserve purchased government debt using freshly printed cash, effectively converting debt into money. However, the Federal Reserve could not directly buy debt from the government, so this process was conducted through the banking system. To address concerns about liquidity and collateral issues in the banking system resulting from this change in monetary policy, the Treasury General Account was established. This account became the government's checking account, held directly at the Federal Reserve. It absorbed the government's full accounts and eliminated the need to worry about assets and liabilities in the banking system. Fluctuations and recent developments. From 2008 to 2019, the usage of the Treasury General Account grew and became more volatile. In 2020, the account reached a peak of $1.8 trillion due to borrowing for COVID-19 relief measures. However, the new Treasury Secretary, Janet Yellen, aimed to reduce the size of the account to around $400 billion. This plan faced obstacles due to issues with the debt ceiling and government shutdowns. Impacts on liquidity and the economy. When the Treasury General Account is filled up, it indicates that the government is receiving more money than it is spending. This reduces liquidity in the banking system, as the cash is not available for banks to leverage and loan out. Conversely, when the account is being spent down, it means that the government is spending at a faster rate than its income, increasing liquidity and stimulating economic activity. Factors affecting liquidity and the economy. It is important to note that the Treasury General Account is just one factor among many that can influence liquidity and the overall economy. Other factors include the Federal Reserve's quantitative easing, changes in interest rates, bank lending practices, and individual spending decisions. These forces can have long-lasting effects on the economy, either providing extra liquidity or making conditions more restrictive. Conclusion. The Treasury General Account serves as the government's checking account, held directly at the Federal Reserve. Its balance fluctuates based on the government's income and spending. While the account may hold a significant amount of cash, it is relatively small compared to the government's overall spending. The movements of this account can impact markets and the economy, either restricting or stimulating economic activity. However, it is crucial to consider other factors that influence liquidity and the overall economic landscape.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.